Okay, back here with Rick Rule, and we're going to welcome our next guest, special guest, Mr. James Rickards. He's the best-selling author of Currency Wars. I'm sure everyone here knows who James is. He delivered a fantastic talk in Boca Raton about the monetary system, the future beyond the dollar. So we want to welcome James up here onto the stage to continue that discussion. Here he comes. James, welcome. How are you?
Good, thanks, Eric.
James, nice to have you back with us. Thank you for your decade-long support of the conference and its various formats. We appreciate it.
Thanks for inviting me. It's good. It's always it's fun, and you do it year after year. You sort of get to know the audience. A lot of people return year after year, so it's almost like an extended family. It's a great event.
It is nice to return to the physical format, even if it's combined with a virtual format. I thought we served the market fairly well, given what we had to do in the COVID period. But it's very difficult virtually to take all of the attendees out in a boat in the harbor and ply them with liquor and have the conversations continue the way they did this time. I want to begin, James, if I could. I was struck today in earlier conversations with Daniela and Nomi about what it's like to be sort of in the middle of the storm. Nomi certainly experienced that at Bear Stearns, and you experienced it at long-term capital management. If you could, happens in the event of sort of one or two standard deviation perturbations in a financial superstructure like long-term capital management, talk about what it's like to be in the storm, and talk about the potential systemic risks that you saw us in there and that you see as being possible looking forward.
Well, long-term capital management was, someone actually calculated the swap spreads and said it was a 13 standard deviation event. That was an eye-opener for me because it was the beginning of my realization that the entire normal distribution and standard deviation methodology couldn't possibly apply to whatever it was we were doing, because that's 13 standard deviations is kind of one since the beginning of the universe. And I said to myself, either we are extremely unlucky, we've had a very bad day, once in 13 billion years, or maybe that methodology doesn't work. But I was a little busy at the time, so it took me years to work out the proper degree distribution, the proper curve shape, and complexity theory, and a lot of other elements that are much better, not just better, they're actually correct in terms of how capital markets and commodity markets work. But at the time, it's an interesting combination because you are in the eye of the storm, but you have a job to do. And that's sort of what, professional training and professional ethics were all about. It's like, I was an investor in the fund, so I was sort of losing money personally, but as was the fund and as were all the other partners. But there was no time you couldn't think about yourself and do your job. You just had to sort of power through it and say, well, this is going to come out however it comes out. I'll worry about that later, but right now I have a job to do. But that was kind of the ultimate in stress, because we had a meltdown. We had a $4 billion meltdown. There was a lot of personal wealth. And the other thing is not well understood, Rick, is that by that point, the fund was 5 years old. We had almost completely displaced our original investors. In fact, the only complaint we ever got from an investor was when we gave them their money back. At the end of 1997, we were up to $7 billion. That was the assets under management. The balance sheet, of course, was 50 times that. The off-balance sheet was 100 or 200 times that. But we were up to $7 billion, and we returned $3 billion in cash. We said, here you go. And we got complaints. They said, oh, you took our money on day one. Now you're giving us some money back. We want to stay in. Of course, what happened was it saved them all, because the typical investor put in $1 on day one that had grown to $4 after 4 years. We gave you $3 back, kept your original dollar. Now, we did go down 92 cents on that last dollar, but you still had your $3. So the average investor experience was they made a lot of money. But we, the partners, others, principals, myself, and others had displaced our own investors. And the only really big external loser was UBS, because they sold us a 7-year at the money call on our own performance. which gave us 100% of the economics. And we actually paid $300 million for the 7-year call on the performance on the 4 billion using Black-Scholes. Of course, Myron Scholes was one of our partners, so he was able to do the math. So we gave them $300 million for the 7-year call. And UBS said to themselves, well, we just sold a 7-year call on 4 billion in performance. How can we hedge that exposure? And they said, aha, we'll put $1 billion into the fund. And that way, as the fund grows and we owe more money on the options, we'll be making money on our fund investment to cover, potential losses on the call option. It never occurred to anyone that we would lose money. That was just, with hindsight, it's obvious, but neither UBS nor ourselves, nor Myron or the mathematicians or myself, I was there. It never occurred to anyone that we would actually lose money, which is what we did. So, so most of the money that was lost, almost all of it was our own money, or UBS went down, lost almost $1 billion, and the CEO was a nice guy. He got fired. Life goes on. But what we were looking at when we called the Federal Reserve in mid-September, by that point, the losses were over $2 billion. We did not expect a bailout. We did not ask for a bailout. We thought to ourselves, are you kidding me? There's no way the Federal Reserve is going to bail out a hedge fund. A bank, yes. The systemic risk, yes, but not a hedge fund. But Peter Fisher, who was from the New York Fed, and Dino Koss, and Gary Gensler, actually, who's head of the SEC today, but he was Assistant Secretary of the Treasury at the time. The three of them came up, and they spent the day with John Merriweather and myself in a conference room. It was on a Sunday. And we just spent the whole day. And we had computers, of course, but we actually printed out the positions, and we turned page by page through hundreds of pages. And at the end of it, I looked at Peter Fisher. His face was white. He was a white person, but it was more white. And he said, we knew you guys would destroy the bond market. We didn't know you would destroy the stock market. And unbeknownst to everyone, we were the biggest risk arbitrage firm in the world. We had $15 billion of equity positions in total return swap form with Bear Stearns, because Bear had put the other side out in the market. They were just intermediaries. But every deal at the time, you go back to 98, Lockheed, Boeing, MCI, WorldCom, Citigroup, Travelers, we were 5% of every one of those deals. So they said, they went back to New York and had breakfast with Sandy Warner and David Kamansky at Merrill Lynch and a couple of the CEOs, and said, we got to do something here, because we were going to shut down every market in the world. It wasn't about us. It wasn't about the bank counterparties. It was about closing every market in the world. We were hours away. We got a term sheet Wednesday night after that Monday meeting. And we closed the deal late Sunday night. I think it was September 28th, if I'm not mistaken. But we were literally hours away from closing every market in the world, sequentially starting at Tokyo and going around the world. What I can say about it, the legalities were daunting. I led the negotiation of the bailout for our side against the 14 families, the 14 big investment banks. Hundreds of lawyers in some of these conference rooms, but I had to kind of stand up and represent LTCM. But what you realize, that much stress, it brings out the best in people and the worst in people. You see some people rise to the occasion, actually act almost heroically, and others, we will not mention names, but at least one guy carried out on a stretcher, not dead, but he was on a gurney. He had a heart attack, and a lot of people, just thinking of themselves, like, why should I sign these closing documents? What's in it for me? Well, excuse me, we're going to shut down the global financial system here. Could you not just sign the documents, and we'll do the best we can going forward? But you need to think about a little bit more than yourself at this moment. So it's very Shakespearean. That's the best way to describe it.
So do you want to ask a question, Albert, before I go on?
Are you changing topics, or are you going to stay?
Go ahead, do.
Because I wanted to ask James about LTCM for so long, and I have a little bit, but it's probably a deep wound. So I usually don't go there. But all I know about LTCM is what I saw in the news, what I've heard from you, James, and the book by Lowenstein. And I'm wondering just about the book. Was that a good book?
It was a very good book, and I didn't reveal this at the time, but I was the principal source for that book. Not the only source by any means. Roger did a great job. But what had happened was he had 120 sources on Wall Street. I mean, Wall Street loves to yak. So every CEO, every risk manager, everyone involved, government officials, they all talk to him. Nobody on our side would talk to him. Nobody. And it was a combination of things. I mean, JM is, had a great guy, a very nice guy, by the way, great boss. He had this reputation as the master of the universe. There was a little bit of Wall Street swagger in there, from the Tom Wolfe novel, but he was actually pretty shy, pretty kind of not reclusive. That's not the right word, but he was kind of a low key guy. A lot of the guys were just really geeks. I mean, nice guys. I'm not disparaging anyone, but when you get up around 165 IQs, it's almost a handicap. You should get one of those parking spaces. But they're good at the math, but they're a little bit robotic. And then other people, I think, were embarrassed. Myron had won the Nobel Prize the year before, and here we blew up the world with his formula. I'm not blaming him. We were all in it together, but. So I think it was embarrassing for him. So between embarrassment, shyness, kind of a geekiness, there was nobody who would talk to the press, and they were also worried about the legalities. And I thought to myself, 100 years from now, we'll all be dead. The only thing left of this will be the book. And if nobody talks to Roger, it's going to be very one-sided. We're just going to be villains because that's how you're portrayed. And I thought, the least I could do was maybe humanize everybody. Like, it had been tough all around, and nobody did it on purpose. You
did a good job of that, actually.
It wasn't extraordinary. So I sat with Roger for 2 days in my library writing studio up in Darien, Connecticut at the time, and he sat there with a laptop, and I just talked, and he asked questions, and then that was that. But then he called me, and very nice, kindly as a writer. I mean, I've written 7 books in the last 10 years, but I was not an author at the time. So I didn't know all the, not tricks of the trade, but just, what it's like to write a book. And he said, you want me to feature you in the acknowledgments or whatever? And I said, no, just leave my name out of it. I'm in the book, but so are all the other participants. But I said, just leave me out of it. And it was sensitive at the time, but it was 22 years ago. And I'm glad I did what I did, and I'm glad it came out the way it came out, because by the way, the book's very good. So it is very accurate. But I just felt that our side was humanized and not villainized. And I thought that was valuable.
Yeah, absolutely. And a follow-up question, James. People point to the moral hazard of that bailout. Certainly the stakes were high, but people point to the bailouts that I guess you and the New York Fed worked out as creating even more moral hazard. And so 20 years later, what do you see? Do you think it's become much worse? Are we much more vulnerable now?
It's much worse. We are much more vulnerable. And that was the start of it. I think you're correct about that. You can go back to, 2008. So, in March 2008, Bear Stearns failed. June, July, Fannie and Freddie failed. August 2008, the Congress bailed out Fannie and Freddie. JP Morgan had sort of lifted Bear Stearns' book in March. So there was a lot of high five. Hey, financial crisis is over. Congress did their thing. And I was one of the ones, not the only one by any means, but I was one of the people going around saying, no, this is not over. And I was working with the McCain campaign at the time. It was a presidential election year. And they were all like, yeah, the financial crisis is over. This is a call in August. Now we can get back to talking about Iraq, because that's the war in Iraq, because that's what they wanted to talk about, because that was a strength for McCain. And I said, no. I said, this is not over. I said, this is not over. You are not going to make it to election day without a much more acute phase of this crisis, because this is dominoes. This is, actually, when I go back to the summer of 07, those 2 Bear Stearns hedge funds, not Bear Stearns itself, but 2 Bear Stearns hedge funds. I think SocGen shut down a money market fund. There were other failures. Then Northern Rock, it was called in the UK. Then Bear, then Fannie, then Freddie. And the dominoes were just falling. Nothing was going to stop it. And everyone knew it was going to be Lehman. I mean, on Wall Streeters anyway, always the weak link. Lehman was one of the weak links in 1998, because that original deal was 14. It was going to be 16 banks, $250 million each for $4 billion. That's what everyone thought was needed. And when they went around the table, Bear Stearns said, no, we're not doing this. And so, by the way, in 2008, when Bear failed, no tears were shed because, Wall Street has very low memory. They were like, okay, you guys, you had it coming. You didn't bail us out then. Too bad for you now. But Lehman, Dick Full was in charge. He said, I can't do 250. I can do 100. And so it was Goldman Sachs, I believe Goldman and Morgan Stanley and Citi, I think, and JP stepped up and filled in that missing hole because of Lehman. But Lehman would have, if we had failed, like gone into bankruptcy, Lehman would have been next. So that was true 10 years earlier. Easy to see in 2008. But I told the McCain campaign, I said, no, get ready, do a 4-point plan. When it happens, I don't know the exact day. I know you're not going to make it to election day. Get your guy on the steps of the Treasury, announce his 4-point plan, just make up the points. Who cares what they are, right? And then you'll get the confidence and the support of the American people because they'll be looking for a leader and you'll win. I was left off the call. I was not invited back. It played out exactly the way I told him it would. John McCain ran around like a chicken with his head off. He barged his way into the White House, into the Roosevelt room, and insisted on a meeting after suspending his campaign. Remember that? And then George W. Bush said, well, I can't invite you and not invite Obama. I mean, I can't make this political favorites. So they had McCain, Bush, Obama in the White House literally about a month before the election, talking about the crisis. But the problem was Obama didn't know any more than McCain, but he was smart enough to keep his mouth shut. And McCain was just like babbling. So people looked at that and said, this guy looks cool. This guy looks scary. And if you look at the polls, McCain had been leading, but they corrupt. McCain went down and Obama went up. And of course, Obama went on to win the election. But the day that those polls intersected and the leader changed was the day of that meeting. So it had political consequences as well. But kind of going ahead to that was 2008. But like I said, when we called the Fed, we never thought we'd get a bailout. We didn't ask for one. They offered. They said we have to do it because you're going to take down Wall Street. See, they didn't bail us out. They put in $4 billion capital and propped up the balance sheet, but they stepped into our shoes and took the positions. They didn't bail us out. They bailed themselves out because I said at the time, I said, if we file for bankruptcy, we had a tax team, we had a bankruptcy team, we had a bailout team, whatever. I said, if we file for bankruptcy, I'll just sleep in the next day. It'll be your problem. And they're like, you're right. So, but it would have been it wasn't just the $4 billion, that was the capital, but we had $1.3 trillion of derivatives. So that was $1.3 trillion that from the bank's point of view is hedged because they had sold us whatever it was, but then they had sold to the market the other side of the trade. Well, when you're an intermediary and you have two sides of the trade, one side goes away, you're either net long or net short. So you got to go into the market and cover, and that covering would have taken down the markets. But that was the beginning of moral hazard, and it's been getting worse ever since.
And given your equity base it was uncoverable anyway. So,
well, but that's the point. You're right, Rick. That's why they would have shut the markets because the market impact of the 14 or 20 biggest banks in the world covering 1.3 trillion instantaneously would have shut down the markets.
So when people look at the big banks today, James, I'm trying to draw today's attendance to the relevance. When we look at banks that are described as adequately capitalized, that probably are adequately capitalized given the events of the last 40 years, but where, as an example, there's 50 or 60 trillion dollars of derivatives on a balance sheet that are valued, assuming that both counterparties pay.
Right. That's right.
Do you think, in the circumstance with the volatility that exists today, that the capital adequacy ratios, the real capital adequacy ratios, are adequate, or do people need to be concerned about systemic risk with regards to leverage on Wall Street?
Definitely the latter, because you go 1998, we talked about 2008, we talked about 2020 with the pandemic. Okay, here we are in 2022. What's happened is the Fed has bailed out the system every single time. in different ways. The 98 was private money, but prompted by the Fed. 2008, that was government money. They converted Goldman Sachs and Morgan Stanley to bank holding companies with a phone call, basically, so that the Fed could bail them out. Morgan Stanley was days away from collapse, and Goldman Sachs would have been right behind them. And then same thing in 2020. But if you look at the numbers and the scale and the base money, M0, what happens, Rick, is that there's successive bailouts, but each one is bigger than the one before, a lot bigger. And so what you have to ask yourself is, does there come a time when it's bigger than the Fed? Does there come a time when the system is so large and the crisis is so extensive and the Fed's credibility is so eroded that this bag of tricks doesn't work? And it is a bag of tricks. It's all confidence. It's pixie dust, as one central banker called it, because QE doesn't really matter. That they print money, but the banks give it back to the Fed in the form of excess reserves, so it doesn't really go into the economy. It doesn't do anything, but the balance sheet keeps getting bigger. And you mentioned, I think you mentioned 50 billion or whatever. I mean, the total notional value of all derivatives in the world is about 1 quadrillion. For those who don't say quadrillion lightly, that's $1,000 trillion. But the problem is, along with this system getting exponentially larger, which means the collapse will be exponentially greater, and the Fed's ability to bail it out will be constrained. Along with that comes complacency, because after the Greenspan put and the Bernanke put and the Yellen put and now the Powell put, this is where the buy the dips mentality comes in, because the stock market goes down. I mean, it went down, NASDAQ went down 30% from November and to I think around June or July. I know it's back up again. I get it. But that was a 30% drop in between October 1st and December 24th, 2018. The stock market dropped 20%. In March 2020, the stock market dropped about 30%. But every one of those dips came back. So you do that enough times and people go, they got my back, Doesn't matter how much risk I take. Doesn't matter what I buy. Just have to ride it out. Don't panic. Don't sell. It'll come back. Well, that has been true. I mean, the data shows that. But again, the question is, does there come a time when it does get out of control and the Fed can't stop it, because the Fed's credibility is on the line. And I think we're there.
Hey, James, it's tempting to monopolize your time, but we got questions coming in through the Q&A tab. This one's from Jean-Marc Staudy, CEO of Riverside Resources. He's interested in your take on interest rates and inflation. He says, for the current inflation rate, how much will the Fed raise in the next step? You were right about 75 basis points 2 weeks ago. What's your outlook?
Yeah, it was very interesting. The last Fed meeting at the end of July, I forget, July 26th, 27th maybe. But they raised 75 basis points, and I did say that. I will say Fed forecasting is the easiest thing I do. There are things I do that are a lot more difficult, but it's because the Fed tells you what they're going to do. All you have to do is you have to listen to them and believe them, but they do leak it every time. So that's the easy part. The hard part is, what are the consequences? How long are they going to go? Et cetera. But they did say that you have to know where to look right now. The Fed has a rotating cast of favorite reporters that they leak to. Right now, it's Nick Timiraos at the Wall Street Journal. Read his stuff. If you see it in USA Today, it's gossip, but if it's in the Journal, it's the real deal. But Powell said, because one of the reporters at the press conference asked him, "Will you do 75 basis points in September?" There is no meeting in August. And he said, "Well, maybe." He said, "We're not ruling that out." But he said, "I'm not going to say one way or the other. But I'm not going to say we won't do it. But it's going to be kind of data dependent, to try it out an old phrase." But what he really said is, we're not going to talk about it anymore. This is going to be like an extended blackout period because we need more data. In the next breath, he said, "Yeah, but oh, by the way, the dots might be right about where we end up on December 31st. Well, the dots are the dot plot. It's the average of all the projections of all the Fed Reserve Bank presidents and the other members of the Board of Governors, et cetera. Those are the dots, which, by the way, I know from confidential sources inside the Fed that they're regarded as a joke inside the Fed. They wish they'd never started them. They can't get out of them, but there they are. But the dots said 3.5% by December 31st. Right now we're at 2.25%. Well, okay, so that means we're going to raise 1.25% between now and the year end, and there are 3 meetings: September, November, and December. So, assuming you don't do odd numbers, that's 50, 50, 25. So Jay Powell said, we're not going to tell anybody what we're doing, but he kind of said, yeah, it'll be 50, 50, 25. The problem is 2 days later, we got a red hot employment report. Now, I could make the case that those employment reports are misleading in the wrong way. They don't reflect the strength of the economy, but it doesn't matter what I think. The Fed thinks they are solid. And so my forecast right now for September is 75 basis points. I just explained why Powell hinted 50, 50, 25, but I've got 75 penciled in. I'll update that between now and September 20th. So we'll see. I don't want to put a stake in the ground, but I've got a 75 because of that employment report. Now, going down the road, the Fed's going to keep raising rates. We're going to get to maybe 4% by year end. The problem is the inflation is not coming from the demand side where the Fed could actually make a difference. The inflation is coming from the supply side. It's energy, it's food, it's transportation costs, it's materials costs, strategic metals, etc. The Fed can't do anything about that. They don't drill for oil. The Fed doesn't drive trucks or plant crops or harvest them or anything of the kind. So think about how much demand destruction you'd have to do on the demand side to offset the inflation coming from the supply side, which the Fed can't do anything about. So, and this is what's crazy about the stock market right now. So there's a narrative and there's a reality. So here's the narrative. The narrative is inflation's cooling off, and according to Biden, it's 0, but it's actually I think 8.5%. But that is down from 9.1. So inflation's cooling off. It's going to cool off faster. Yield curves are inverted, and they are. So it looks like the Fed's going to pivot, meaning not only stop raising rates, but maybe actually cut rates early next year. And rate cuts are good for stocks, so buy stocks. So that's the Wall Street narrative. Here's the reality. Inflation may very well be cooling off. We'll see, but it could be. But if it's cooling off because the recession that we're in is a lot worse than anyone expects. In other words, it could cool off a lot. If unemployment goes up to 7 or 8%, you're not going to be worried about the high price of gas if you're not buying gas because you're unemployed. So and that's bad for stocks. So in other words, if inflation continues to rip and the Fed's got to raise interest rates to like 5% to deal with it, that's going to crush stocks. But if the inflation goes down, it's going to be because we're in a worse recession. The Fed is tightening into weakness, and a recession is bad for stocks. So it's bad for stocks either way. That's how it's going to play out between now and the end of the year and early next year. But that is not what Wall Street's selling right now. What Wall Street's selling is pivot. Inflation's over, Fed will pivot, and that's good for stocks. But that's not how it's going to play out.
And, I agree with Jim in that whatever price relief we're going to get in the next quarter or so is going to be basically the sign of a recession setting in. But Rick, I want to ask you, we don't know where interest rates are going to go, but if James is correct, 4% by the end of the year, what does that do to major markets? 4%.
I think it hurts them. Increased interest rates do two things. They increase companies' cost of capital, which is an important input, which reduces margins, and it decreases the capitalized value of the distributions by way of dividends. It's as though you have a bearish numerator and a bearish denominator. So, I hope they continue to raise interest rates. I don't like a circumstance where you penalize savers at the expense of spenders. I wish they would deregulate interest rates and get it over with, although that would be an interesting experiment. But I do think that the circumstance that James describes, particularly in the context of what feels to me like a recession, is not good for equities. Now, the truth is that I was probably 30 when I stopped buying markets and started buying stocks. Okay. And there are going to be companies that do well enough that they will offer you some safe harbor as you do the work. But to the extent that you buy the dips because you think that the Fed has your back or something like that, a rising interest rate environment is a much less benign environment for most types of investors than a falling interest rate environment.
We go from almost everything works to almost nothing works.
Right. I've been through both, and I can tell you that benign climates are much more fun. Less benign climates might be more interesting in the sense of that old Chinese curse about may you live in interesting times.
So yeah, I think we have to move on, actually, going back into the networking hall. But James, I want to thank you for joining us in Florida this year. That was a lot of fun. I especially enjoyed the panel that we shared together about the super bubbles and that theory. I hope we actually get to continue that discussion, maybe in real time as the thing's playing out, but I hope we get to discuss that again. And thanks for coming on the platform here. Really appreciate it.
Thank you. Thanks for inviting me, and have a great weekend, everybody.
All right. Thanks.
Thank you.
Thanks very much. So yeah, James, he's always a great guest, great speaker, and just like a wealth of experience. That's the first time we've really gotten into the LTCM thing. I've alluded to it, but like I said, I imagine there's some fairly deep scars with that.
I've had a very interesting time talking to James about that circumstance more informally in the bar. And it's really fascinating, his own experience with it.
Yeah.
Going from being a complete believer in convergence and leverage convergence to a guy who experienced the
Yeah.
moment. It was transformational for him. And what's nice is that he's self-honest enough that he's able to describe the pre-LTCM and the post-LTCM.
Right.
James Rickards.
Right.
The other thing that I want to point out, Albert, and I'm sure you noticed this, his willingness after his presentation to stand and talk to attendees.
Oh, yeah, it's great.
His desire, frankly, to interact with all kinds of people. You and I both know that we've had high-profile speakers in the past who regarded themselves as hired guns, who parachuted into the conference,
Yeah.
left at their earliest possible moment, cashed their speaker's fee, and moved on. And James Rickards is not one of those. He participated in the conference, which I'm forever grateful about.
Yeah. None of our speakers this year, actually, they all participated. And I guess that's one of the benefits of going, right, in person. Although, this does allow for that, but being in person is definitely great. So, okay, so we're going to go back again to the networking hall, Rick. This has been quite a marathon for you, but we're going to go back there. We're going to come back at 3:05 with Grant King.
Great.
Of Hot Chili.
Looking forward to that.
All right.